Welcome to the Chirsman Commentary, daily mortgage news podcast. I'm your host, Robbie Chirsman. Topics on today's episode include why mortgage rates are where they are, what the latest payrolls and labor market data this week reveal about the direction of the U.S. economy and Federal Reserve's monetary policy, and my interview with Digital Risk's Kimberly Lanham on how the Iran conflict and broader geopolitical uncertainty are influencing mortgage rates, borrower decision-making, servicing retention strategies, borrower assistance programs, and emerging credit and fraud risks across both agency and non-QM lending. Here, take a listen to a little preview.
Retention, recapture, the huge topic right now in the industry. The trigger lead ban has been in place for exactly 2 months at this point. Have we started to see, will we see an increase in retention rates? What about purchase versus refi retention rates? And I will add, refi remains relatively strong despite the rate environment. I think MBA's latest application index, refis are up about 29 or 30% year over year from where they were a year ago. So that's chugging along very nicely.
Yep, absolutely. I do think that this shift in servicing is, we're seeing the shift in servicing. And I actually, thanks for asking this question, because I believe this is one of the most important and underappreciated topics that's going on in the industry right now, with servicer retention specifically. And it's improving by almost necessity, because if you're the borrower servicer and you're often the only party who has the opportunity and who knows when the opportunity exists, if rates shift at a moment's notice, what positive momentum that can have for a borrower. So if you know your portfolio, and especially if you're monitoring your portfolio as rates ebb and flow, you know immediately who could benefit from that and who can't. And that's an informational advantage that's a huge competitive advantage, especially in a rate volatile market like we're in right now. I also think that because I've been following the trigger lead bans for quite some time, and it's been interesting to see, the fight. I was up on Capitol Hill a couple times in talking to Congress about it or congressmen about it. And I absolutely think it helps, right? It really reduces noise. It improves the borrower experience, and it lets the servicer who already has that relationship be the first meaningful point of contact. That's better for consumers and better for outcomes. And as we know, kind of during the height of the craziness with the trigger leads, people were getting 9, 10 calls once they were trying to do some kind of a refi, and they weren't sure who they were talking to. There was some disingenuous people on the phones, kind of trying to sound like they were the lender of choice, but they really weren't. And so there was started to be some serious borrower mistrust, and that's not good for our industry. So, I think that these leads these leads being banned are really good for the industry. But if you want to talk specific numbers, we could talk specific numbers around retention. So purchase retention is roughly 20 to 25% industry-wide. And while that may sound low at first glance, it's actually up meaningfully from a few years ago. And then refi retention is stronger, 28% overall, with a 37% on rate and term refis. And then, some platforms like Rocket are citing 80% in some of their channels. So I think that, as we see this consolidation with servicing, you got Rocket and Cooper, Bayview Guild, now you've got UWM and Cross Country Mortgage aggressively competing for Two Harbors. All of that investment only makes sense if retention improves.
Headquartered in Austin, Texas, First Close Inc. provides fintech solutions to HELOC and mortgage lenders nationwide. At First Close, their mission is to power elegant experiences for borrowers, financial institutions, and providers. Their home equity lending platform accelerates the home equity lending process, reducing application to closing times from 45 days to less than 10. For more information, visit firstclose.com. Yes, interest rates are driven by inflation and thoughts of future inflation, neither of which help fixed income securities. After a brief pause in hostilities, the U.S. and Iran resumed exchanging fire yesterday as Washington pressed Tehran to accept a proposed framework to end the conflict, reopen the Strait of Hormuz, and ease energy market disruptions. Though Iran continues to resist key U.S. demands surrounding its nuclear program, all of which contributed to a slight rise in bond yields. Economic data released yesterday revealed the first quarter productivity growth slowed to 0.8%, well below expectations, but the deceleration in unit labor costs to 2.3% helped ease concerns that inflation pressures are reaccelerating enough to force the Fed toward additional tightening. More on the Fed in a second. March construction spending was boosted by strength in residential and single-family building activity, while consumer credit posted its largest increase in a year, potentially signaling that households are leaning more heavily on borrowing amid elevated living and energy costs. No investor wants to pay 104 for a loan that pays off 5 months later, and April's prepayment data showed agency mortgage speeds cooling meaningfully, with aggregate Fannie Mae 30-year CPRs falling 16% month-over-month to 9.2 as seasonal slowdown, unchanged refinance incentive, and relatively stable mortgage rates combined to suppress turnover activity. While speeds remain above year-ago levels, extending a nearly 2-year streak of annual growth, the broader trend suggests the refinance wave is stabilizing rather than accelerating, with the MBA refinance index also losing momentum amid sideways rate movement. Higher coupon pools, particularly 5.5% and 6% securities, experienced the sharpest slowdown in prepays, though lower loan balance and New York specified pools continue to demonstrate resilient call protection characteristics despite the broader decline. Meanwhile, only about 11.5% of outstanding 30-year borrowers retain refinance incentive, effectively unchanged from March, supporting expectations that prepayment activity should remain range-bound through the summer, even as investors continue watching deeply discounted low-coupon pools for signs of eventual turnover normalization. For some good news for lenders, agency mortgage-backed securities have quietly become one of the best performing sectors in fixed income, which comes down to excess return. Mortgages have optionality because any American homeowner can refinance or prepay at any time, and the taxpayer backing means investors will get their money back. The real question is when, and that uncertainty has to be hedged out relative to treasuries. Volatility matters enormously in mortgage math, and banks have become much more comfortable stepping back into the sector as deposit growth outpaces commercial lending growth. Put another way, they've got excess cash to deploy, and while they remain overweight treasuries historically, they've been increasingly putting money into agency MBS. Mortgage-related fund flows have also been very strong, especially from index buyers, while supply remains historically muted. Net issuance is running well below the levels seen over the last several years, and even more importantly, actual loan creation remains depressed when viewed in unit terms rather than inflated dollar figures. The composition of issuance has shifted materially as well, with Ginnie Mae now accounting for more than 40% of production compared to roughly a quarter during quantitative easing 4, which says a lot about affordability stress and the growing role of government-backed borrowers in the market. When you combine strong fund flows, returning bank demand, and restrained supply, agency mortgage-backed securities have had powerful technical backup, although valuations are beginning to look stretched. There's definitely been a pickup in refinancing activity among more recent borrowers sitting in higher coupons, but the reality is that nearly 90% of borrowers remain deeply out of the money after locking historically low rates earlier this decade. Only around 12% of conventional borrowers have refinance incentive, with similar figures across FHA and VA. Speeds have responded accordingly, with temporary bumps that quickly fade as rates stabilize or drift back higher. What's more concerning longer term is the underlying health of housing affordability and the increasing risk layering occurring in portions of the market, particularly within Ginnie Mae collateral. Down payment assistance usage among FHA borrowers has surged dramatically, bringing lower FICO scores, higher debt-to-income ratios, and materially higher delinquency rates with it. That's where the real concern sits, because affordability has been pushed to uncomfortable extremes. Housing itself has become a tale of two markets. Existing home sales remain severely constrained by inventory lock-in, while builders have managed to keep new home sales moving through incentives, giveaways, and price cuts. In many parts of the country, prices are finally beginning to soften, especially in formerly red-hot states like Texas, Florida, and Colorado. And while people instinctively fear falling home prices, price corrections are often what restore balance to a distorted market. Longer term, the structural shortage of single-family housing remains enormous because the U.S. simply has not built enough homes for more than a decade. Overlay all that with a Federal Reserve that continues cutting rates despite inflation remaining well above target, and you get a market increasingly skeptical that monetary easing will meaningfully lower long-term borrowing costs. The Fed can cut the front end all at once, but as recent history has shown, the bond market ultimately decides where longer-term rates settle, especially in an environment where inflation pressures remain embedded in the system. Recent comments from Fed officials signal a growing shift in focus toward inflation risks, with an emphasis that elevated energy prices are more of an inflationary shock than a stagflationary threat. The acknowledgement that persistent inflation is becoming increasingly concerning, despite a stable labor market, reinforces the likelihood that the June FOMC statement will adopt a more balanced tone around the risks to future rate policy rather than leaning clearly dovish. The Fed doesn't set mortgage rates, but at the same time, debate around the Fed's balance sheet is intensifying, with Fitch Ratings cautioning that any aggressive reduction could destabilize overnight funding markets and recreate liquidity stresses similar to the 2019 repo disruption. Incoming Fed Chair Warsh has expressed the view that any meaningful balance sheet normalization must be gradual, deliberate, and carefully communicated, underscoring the broader challenge policymakers face in tightening financial conditions without triggering unintended market volatility. For today's interview, I wanted to welcome to the show Digital Risk's Kim Lanham to talk about how the Iran conflict and broader geopolitical uncertainty are influencing mortgage rates, borrower decision-making, servicing retention strategies, borrower assistance programs, and emerging credit and fraud risks across both agency and non-QM lending. She's Senior Vice President of Client Services at Digital Risk and is a published author, requested speaker, and frequently sits on various symposium panels, as well as organizes national industry summits.
How do you think the war in Iran is going to impact the rate outlook for 2026? And it shifted things a little bit from rates shot up 1/4 to 3/8 of a percentage point initially, depending on loan product. They've been sticky, and the thought is either, okay, well, inflation is going to remain high from the blockade in the Strait of Hormuz. Normally, when there's geopolitical disruptions, rates go down, and there's a flight to safety in treasuries, the safe haven asset. We haven't necessarily seen that. Thoughts on the rate outlook? And actually, I'll throw in my 2 cents and say, I would not expect much rate relief in one direction or rate increase in one direction. I think we've kind of settled into a new normal here, but nobody can predict interest rates. So take your stab at it, please.
I think the richest person in the world would be the one who could predict interest rates. But yes, you're right. So thank you for having me, Robbie. And rates are volatile, but they're holding in around the sixes. And here's the other really good news. If you look at the recent MBA and Fannie Mae forecasts that have come out for 2026, right, they've converged. So they're both forecasting around low sixes for the rest of the year. And I think those forecasts they're designed to smooth through all this volatility. They're designed to, assume all of this geopolitical uncertainty and risk and inflation risk. And I think they're also built into, to assume some of the quantitative tightening that might be happening by the Fed. But what's interesting, kind of what you said, which is, I think, a common belief, is that there is this flight to safety, right? When there's a military conflict. And actually, historically, that's been shown to be not true. So in fact, when you've looked at prior U.S. conflicts with Iran or, in the Middle East specifically, Treasury yields have risen more often than they've actually fallen, especially at the onset. And this is largely because of, just what we talked about, energy prices rising, inflation expectations, and bond investors really starting to demand more yield. So that's exactly what we've seen this time. Really, that's what we've seen this time around. Oil spiked, inflation break-evens moved higher, and the 10-year Treasury followed. And as we know, mortgage rates are tied to the Treasury. So if plus the spread, so that volatility is going to show up really quickly and immediately for borrowers.
Well, if you are a loan officer out there that clients are looking to for trusted advice, how should you be talking to your clients about locking now versus locking later, especially considering there's a lot of uncertainty out there? Maybe I'll throw in my 2 cents again, and you can tell me I'm wrong again. But I always thought one in the hand is better than two in the bush when it comes to locking rates.
Right. Yes. So I'm again, right, probably for your loan officers that are listening to this is preaching to the choir. But I think it still needs to be said pretty clearly, just, like you did for purchase loans, you've got to lock as soon as you reasonably can in the process, full stop. You've got to lock. And I think when markets are being driven by global headlines rather than housing fundamentals, which is where we are right now, rates can move very quickly without warning. And again, going back through history and kind of looking some of the historical data, it shows that the downside risk of rates jumping is faster and more common than rates, kind of on the upside reward, going up, coming down, which really that tends to happen very slowly, where they tend to jump very quickly. And so I would, again, I think they should, especially on purchase, need to lock rates as soon as they can. And then on refis and some other, some refis, I would say this matters, rate locking really matters when you've got borrowers who are really close to DTI limits or have a fixed monthly payment ceiling and would be material impacted by, even a quarter or an eighth of a percent move. And so I think that for borrowers, especially those borrowers, locking isn't a rate call, it's budget protection. And so I guess I would say to your loan officers that are listening right now, rates are being driven by global headlines and global events, and not the housing market. So locking protects your payment from sudden increases. And if rates improve later, there's still options for your borrowers. So locking is about managing risk, not predicting headlines.
Let's move from locking rate to actually thinking about shopping for a home. Because we'll role play here one more time. If I'm a client, you're the loan officer, what are you telling me if I'm going, I might wait to buy until the Iran conflict plays out a little more?
Yeah. And I would say this is where perspective really matters, right? So life doesn't pause for geopolitics. You've got family growth, you've got jobs, schools, relocation, all of these drivers into wanting you to buy a home. Don't wait for global uncertainty to resolve itself. And so I think that if the house is right for you and you can afford the payment, you should absolutely be moving forward. And it's also really important to note right now that even after all of this volatility and these spikes that we've been having, rates today are still about 50 to 75% basis points lower than this time last year. So that is real monthly savings for buyers who can afford today's payments. And so also affordability isn't just about rates, right? Inventory is starting to actually increase. Price cuts are becoming more common. Builders are offering more incentives than I've ever seen. So waiting for this kind of perfect all clear moment really is actually giving up some significant negotiating power that buyers have right now. And so I would say, no one can predict rates, as we just talked about earlier, especially in a headline-driven market. And if the home fits, take the step forward and manage the risk.
Things have waned a little bit in terms of the pandemic. There was this forbearance, there was relief, and it was easy for people to defer payments. A lot of that's tightening up. Ways in your mind, at least, do you feel like servicers can really help borrowers and make a difference when it comes to ultimately recapturing them down the road?
Yeah, so I absolutely think there are a lot of ways that servicers can help borrowers. And I think the data is pretty clear on this. And I do think that a lot of it goes back to, what we were just talking about. So during the pandemic, that was what we call a temporary income shock. People were suddenly losing their jobs with, good jobs. And so they didn't know what to do. And so everybody was scrambling and trying to help these people keep in their homes because it wasn't necessarily their fault that they were losing their jobs. And now I think what we're dealing with is more of a structural affordability stress on borrowers. So we're seeing, that's because if you kind of go back to the pandemic till now, inflation is up 25 to 27% roughly cumulatively. And so if people's incomes have not also gone up 25 to 27%, we've got some structural affordability stress. And so I think servicers are going to have to pivot, and I think they're going to have to get really smart and use systems like Sagent that's got a lot of technology built in to give a lot of, red flag, early monitoring, early notification when things don't look right, because the mods, the 40-year extensions, the partial claims, right? Those are all failing at alarmingly high rates right now. And when you increase the borrower's payment increases, they drive default, period. So we've got to get creative in the servicing world about how do we help these borrowers, but not increase that payment, because that's ultimately going to not solve the challenge that we're looking for. And so again, I do think that going back to some really payment-centric interventions is what needs to happen. So we talk a lot about escrow shock in servicing. And so it's great when you get your mortgage, especially for these people who have very high DTIs. Again, going back to that 49%, they've got what they're going into a mortgage payment with their insurance and taxes are at a set number, and it's pretty low, right? It's like $250 a month. And then all of a sudden you get a 30-40% increase, or you get a 30-40% increase on your HOA fees or your condo loans. That's just enough to throw these people way off into their DTI, and that breaks the borrower.
I'm a victim of that. My most recent escrow analysis increased my mortgage payment by more than $900 a month. And so it's certainly a shock that you don't always hear. Anyways, we're not here to talk about me. We're here to talk about digital risk. We finally got to the point we can talk about digital risk.
Okay.
You like that segue? Your firm's main role is doing due diligence on loans to help keep the overall system safe.
Yep.
What are you seeing with loan risk? Are there certain trends more like fraud? Does the rise of non-QM pose more risk, or is it safe? Other trends? How do you like that? 5 questions in one to end this interview?
I'm going to answer all those questions.
Right.
I may not answer them in the order you asked, but I will answer them. So, digital risk, we've always been known for due diligence and quality control. We've been around for a little over 20 years now, and that's really what the company was founded on. And we were founded on the crisis in 2008 and looking really at that loan level, the issues at the loan level to kind of come up to the big picture to say, hey, things don't look so good from a big picture. But what a lot of people don't realize is that we have a much broader role. So if you add up all the production that we do for our clients on a white label basis, we'd effectively be the 11th largest originator in the country. And so that means that we're seeing loans across the entire life cycle. We see loans from origination to QC, through securitization, capital markets, servicing handoffs, and then portfolio surveillance. So that gives us a really great vantage point into loan risk, systemic risk, kind of what's going on. From a fraud perspective, I would say that we're not necessarily seeing more fraud volume, but we're seeing much more sophisticated fraud. So the bad actors are evolving. And what we're finding is through, you can't find this fraud at the loan level. Like you may find one loan with one bad actor, but to really find these very sophisticated schemes that we're starting to find out what's going on, you've got to do some major pattern recognition over a full gamut of, full portfolio of loans. And so really to start pulling red flag management. And so we are developing a lot of AI technology around that. And then, helping with the red flags and the identification of these patterns of a conglomerate of bad actors. It's not just one. And so it's really almost been impossible to kind of look at that pattern overlay manually because it's so much data. But with AI and our deep domain experience and mortgage, we've been able to really kind of ferret a lot of that out. So interesting that you asked about non-QM. I was listening to your Cinco de Mayo podcast. And
hopefully, did you say for my favorite joke of the year where we talk about how the Titanic was carrying mayonnaise and it was a national day of mourning in Mexico, and so they call it the Cinco de Mayo? Anyway. All right. I'll be here all week.
Great joke. That's okay. You'll be here all week. But I do agree with Dane. That overall non-QM is not inherently risky. So from a diligence standpoint, what we're seeing come across is very well documented. It's underwritten with strong compensating factors. And what we're seeing is that it's held by investors who are far more disciplined about cash flow and their performance and the capital requirements required behind that. So I don't think the product is the big risk. I think it is if you have organizations that have, poor oversight and weak controls. But what we see coming across, non-QM, the DSCR, the bank statements, all of that. And that's pretty much besides digital HELOC that we're seeing traded right now. And we aren't seeing anything that is, alarming us at any level at all. It's really quite safe and sound.
Kim, ton of good stuff here. Very much appreciate you making the time. Hopefully this is the first of many, and I'll be vain and say hopefully you enjoyed this as much as I did.
I did.
So thank you.
Absolutely. I would love to come back and talk. Maybe we can talk about that systemic risk on this non-QM and see how that plays out later on, or some other things we see going on. But I would love to come back. So thank you.
Let's do it.
Ahead of April payrolls that were released just a couple of minutes ago, labor market data has reinforced the view that employment conditions are cooling gradually rather than deteriorating sharply, with initial jobless claims rising modestly to 200,000 and continuing claims edging lower. The labor market remains in a low hire, low fire state while tech sector layoffs continue to mount. Today brought April non-farm payrolls, which came in at 115,000 versus 67,000 estimates and 178,000 prior. The unemployment rate came in at 4.3% versus consensus and prior 4.3%, and April hourly earnings. Later today brings March's wholesale inventories and preliminary May University of Michigan consumer sentiment. After the job data, we find agency MBS prices improved versus Thursday's close, the 2-year yielding 3.89 and the 10-year yielding 4.37 after closing yesterday at 4.39%. Let's wrap up with a joke and some housekeeping. A group of aging rock stars are hanging out and comparing who has received the most impressive gift. They're in Roger Daltrey's house and he's showing off an exquisite pinball machine. This custom Tommy pinball machine was given to me by the Prime Minister of Sweden. He loved Tommy so much he had it specially made. The balls and all the metal fixtures are made of real sterling silver. Paul McCartney says, "That's nothing," and pulls a jewel box out of his pocket. "This 24-karat gold beetle was given to me by the Emperor of Japan because he loved the Beatles. The back is made of a giant emerald." Mick Jagger says, "That's nothing," and pulls a piece of cheesecloth out of his pocket. "This piece of bread was given to me by the Prince of Monaco." Before he can even finish, the other two rock stars and everybody at the party start laughing at him. "What the hell? A stupid piece of bread." Mick gets really serious and says, "Hey, I know it's only Moroccan roll, but I like it." Headquartered in Austin, Texas, First Close Inc. provides fintech solutions to HELOC and mortgage lenders nationwide. At First Close, their mission is to power elegant experiences for borrowers, financial institutions, and providers. Their home equity lending platform accelerates the home equity lending process, reducing application to closing times from 45 days to less than 10. For more information, visit firstclose.com.